Hi, everyone. Welcome to Brainstorm. I'm Carson Cook. I'm joined by Membrane's head of product, David Golding. Today, we're speaking with David Pleshek, Chief Operations Officer, and Ryan Day, Chief Marketing Officer of Solstice Labs. Well, let's get right into it. Maybe we can start with you telling a little bit about yourselves and about Solstice Labs and what your general goals are.
Sure, I can jump in first. I'm David Pleshek, COO of Solstice Labs. I've had a bit of a winding career in this kind of Web3 and banking world, going back and forth between fintech and building technology companies. In a previous life, I worked in the Foreign Service as a bureaucrat, and that kind of got me started on the journey into cryptography and this world of like doing things for ourselves. So yeah, really happy to be here.
Yeah, and I'm Ryan, glorified tweet boy of Solstice, and sometimes I put together some marketing strategies from time to time. I got into this industry actually because I love doing stuff like this. So I was actually doing a lot of B2B sales and was doing podcast sales, and so then joined Blockworks back in the day, selling some of the podcasts there, and then the rest is history. So now I'm here doing all the fun stuff, which is very exciting. And then Solstice, I guess a very high-level overview of Solstice. We're a delta neutral yield firm, and we are the largest native stablecoin on Solana with 300 million in TVL right now, and we're delivering delta neutral yields across the greater Solana ecosystem. So with much more to come down the pike.
I think that this is a great segue right into talking about, in general, the idea of yield-bearing stablecoins, and rates across the market. A lot of interesting things are happening. So I guess our first topic, we can talk, in general, where is Solstice seeing real demand for yield right now in the market? What are the main yield use cases you guys are seeing?
Yeah, I guess I can kind of jump in here. I think it's quite interesting what this demand is really looking like. We've predominantly built our infrastructure in Solana, and Solana is a bit of a niche, unique use case for attracting these kind of DeFi yields. But just like any product, really, we've kind of seen that in our own data. Ryan can probably speak to this even in more detail, but we've probably had outreach and exposure to millions and millions of people now. Like loads and loads of people know about who we are, and of that, we've had this kind of conversion of maybe 10% or something into like a user base. So there's probably 150,000 users that really know of Solstice and are interacting with our application, our product. But then from that, the true conversion down into yield is probably 15% of that again. So you kind of way down that rabbit hole. So that's pretty standard product, right? Awareness, and then you have conversion, and then you have real people engaging with your product. So we would have 25 to 30,000 active users, and so we can see it in the data what they're really looking for. And what it boils down to, which is probably as obvious as it seems, these people who do confirm and convert into being Solstice users or our asset users are seeking kind of a couple of things, which is just security. They're seeking kind of clarity around exactly what this is, and then they're seeking a high level yield number. And posting great yield numbers really drives user demand, but not as much as you'd think. If you start to compare where Solstice is with like a relatively modest kind of TVL level or assets under management level compared to some of the other larger projects, the number of like active addresses and active users month to month is not too different from like the really big end of town like Athena. So yeah, it's interesting to see that it's not really about just the amount of users or the reach you have, but it's the types of users and what different types of demand they're looking for, what they're looking for when it comes to these products that provide them the yield.
When you think about yield, right, there's obviously the headline number. Are people just looking to hold the asset? Are they looking for liquidity? Are they looking for optionality? Are they looking for using it as collateral? I guess when you think about yield, there's all sorts of things that are baked into it other than the headline number. Is there anything there that you guys are seeing?
Yeah, I think like where we see a lot of uptake is what's been really, really helpful for us as we grow is the integrations across the ecosystem, right? So we have pretty deep integrations with Kamino and Exponent right now. And so like having, a delta neutral yield is nice, but for some of the more power users, right, being able to put that into PTs or YTs or do some lending with it or, earn future points on a future token, right? There's a lot of other stuff that comes in layered with just like the baseline yield number. And so it's really, when we turn on these new partnerships, it's really interesting to see how the new users either like suddenly become like LP providers or suddenly become like fixed rate yield holders, or they're chasing this like endless YT leverage on yields kind of stuff. And so it's fun to see how these new integrations are working. And so we're working every day on different implementations of that. So it's what does it look like if USX or EUSX, which is our yield bearing component, is mixed in with blending? Okay, we've done that with Kamino. What does it look like if it mixes in with everyday payments, right? What could that look like? What could it look like if it's helping back some sort of neobank, right? What could that look like? And so we're chasing a lot of those things down because I think yield, right, is one of it's the core like product that we have through a few different things. And how do we integrate that more deeply? And what's great about like broader DeFi ecosystem is people will take that yield and just go do really fun things with it that I'm learning about all day, every day. And so it's really nice to see.
One question I had about your kind of general user base, are they generally kind of core Solana participants that come into Solstice? Are you actually seeing conversion where people are looking for a solution like yours, a synthetic dollar like yours, and actually coming over to the Solana ecosystem from the broader space?
I kind of see it in, these big, large buckets, right? So we have this like huge DeFi retail community that already exists on Solana. And I kind of bucket the multi-chain stuff into one thing. It's just like, there's a whole bunch of people that already know about this and they understand the power of composable assets. And they they can take one thing here and do this, borrow land and yield trade, things they need to do. So, that's this world that kind of Ryan really is focused on a lot around like really getting the message out to the individual end user. And then there's this whole other world, which is, 90% of the universe who are either institutional liquid funds or institutional investors that are kind of looking to dabble in this space and see what they can do with, these types of assets that are either collateral quality or have some yield attached to them. And then there's these emerging kind of family offices that are like, what does this really mean? I'm willing to kind of take a bit of a punt here and find something out, learn something, and they want to go on that journey. And then there's this last bucket, which is where we're really thinking about taking Solstice into 2026, which is, most people in the world don't think about the money the way that we do as like, finance professionals. I guess you kind of think about us that way. We're kind of thinking about money all the time. Most people just have, jobs that are totally disassociated with that and they get paid to do it. And so their capital is in all these other platforms. They might be playing poker on the weekend, or they could be, a content creator in their spare time, or in a marketplace where they're kind of selling vintage clothes, and they've got capital sitting in these places. So, what's the future of like bringing those types of yields that we deliver inside the DeFi ecosystem to these other fintech platforms? So yeah, we're starting that journey as well, and looking for more design partners, but like right now working with the lowest touch version, which is people who already have a platform that's interacting with DeFi. So yeah, I really think about it in huge buckets of different user bases that are all seeking the same thing. However, how we provide it to them is completely different, which makes it extremely complicated. It makes our industry super exciting, but yeah, keeps you up for many hours a night.
When we think about market participants, right, obviously each of these participants have different understanding of the underlying trade, different ability to kind of, I guess, vet and understand various trading strategies, right? How, I guess, when you think about talking about the yield, how do you reconcile what some market participants might think they're earning versus what might be the practical yield, right? And I'm talking about things like, funding costs, liquidity constraints, exit frictions, anything like this that, may not be embedded in the headline yield. How do you think about educating? How do you think about that from a market structure perspective?
Yeah, I think about this a lot, right? And it's, it's really interesting. I'm not going to sit here and tell you that like the headline number that we put up or anybody's putting up is the number that we're offering, minute to minute in the yield. There's a reason why you kind of invest for the medium to long term. You're not trying to get in and out of these things unless you're a professional trader. And so these APY numbers tend to be like a look back on track record or, an expectation across what the year is going to look like. So a lot of the headline numbers you'll see, yeah, they're not exactly what they are going to play out to be. But the structural thing is really in education. So for us, the majority of what we do in generating the alpha or generating the yield comes from us running funding rate arbitrage. We do that in a institutional grade way. So we kind of use custodians and then we use the venues to make that happen. But right now is the perfect example of a bad time, right? Over the last couple of months, the market's been moving into a regime where prices are coming down, leverage is coming out of the market, and the funding rate comes down with that. So the regular investor looking at these assets or someone who's looking to use a yield-bearing asset for collateral needs to be aware of these underlying mechanics and then how they start to think about, well, what does the haircut do in the future on those types of things. So when the market then turns around, so what we really want is like a rapid turnaround of a regime where the price goes down really fast, finds a floor, and then we turn back into a regime of like growth and leverage comes back into the market. And if you're not prepared for that, then these headline APY numbers that you're putting up tend to be not as high as you might be able to achieve. And so what I mean by that is we kind of need to stay in the bad trade, even though the numbers are going quite low, so that as soon as the funding rate turns around, then we're in position, because it will take us 2 weeks to pull in, especially hundreds of millions of dollars, which we have under management. So that's like education that we need to do to the market, so that when we're working with counterparties who want to use our assets for collateral, or even if it's just DeFi farmers who want to take it, lend it into Kamino or lend it onto other markets like Aave, those types of things need to be factored in. So it's quite an educational journey, but it's not simple, right? It hasn't been created into something that is simple, and it's not supposed to be.
Yeah, it's very interesting because I think there's like a dichotomy on the customer base, right? Like we have this like 70-30 split of like institutions and DeFi natives, right? And the institutions think on like 3 to 5 year timeframes, right? And so when you talk about like a 12-month APY, they're like, oh, that's actually like pretty amazing. But like Athena, I think spearheaded this, and again, they spearheaded everything in this kind of delta neutral yield. So like kudos to them. But they started this like 7-day APY where you take like the week's earnings and then like stretch that out over 52 weeks, which is like, it's like a very volatile number to be like attributing what you're expecting to earn for a year on a 7-day period. And so but the DeFi natives, they need this when they're going out there to do all their kind of leverage, or if they're looping, or if they're lending, or if they're whatever, right? They need to understand that like very short-term thing. And so educating people on what this trade is, which is like, in traditional finance, you get quarterly updates on how the trade's going, and maybe it's a little up, maybe it's a little down, over the course of the month, we're having positive returns. But on one day for a DeFi user, if there's like any sort of zero or negative returns, or like the market crashes, like that fundamentally changes their trading strategy. And so it's a very interesting dynamic to try to talk to both sides of this audience that need very different communication lines and systems all in the same kind of user interface. It's just very interesting.
Yeah, and I think you mentioned exit frictions. I like this is something that's really it's really understood. There's not a lot of people that are really thinking about this properly and like implementing what the kind of solve for the challenges, right? We think about it internally as like value at risk and cash drag, and like exit frictions are something that are in place so that you can move out of a position and provide a user with liquidity buffer, right? Which is the liquidity they need as they're trying to exit your strategy and move on to something else, or whatever might happen. But like the interesting things that happen into the traditional markets, like around overnight lending rates, are things that can be brought into this crypto ecosystem and solve some of those like exit friction problems. And that's the stuff that's exciting about kind of where this space is headed.
Would it be safe to say that kind of the upside yield attracts retail quickly, and then the management of the downside risk is what attracts the big institutions over time?
Yeah, I think and I think like it's tough for me to do my job as like trying to talk to a lot of the retail side of the equation with numbers that are like right in the realm. I mean, with other people, right in the realm of T-bills. But I think that people are starting to understand, right? Like to what Dave was saying, there's like 4 to 8 weeks of the basis trade of the year makes the year. Mm-hmm. Right? Like that makes up for all of this downtime, because we have to sit around in this trade and posting low numbers, because then it's not expensive for us to get into the trade when everyone else is trying to catch up and they're rotating capital in. we're already there. Like we're already getting the best rates, that kind of stuff. And so then we will be able to deliver those high numbers. But if you're not in the trade with us at the time, it'll take you a bit and you'll be missing some of that. And so your personal APY will go down over time. And so I think like, especially what's like, granted, since 1010, it's been quite a market. But what's nice is a lot of people are like, well, I don't even know what to do. But the one thing that I do know that keeps going up and to the right is like delta neutral in this instance. So it's like we have seen a nice influx of people who are like, I don't even know where to trade, but I want to make sure that I have more dry powder once I go out and I do get back into the quote unquote trenches and do get out there and do whatever. They have the opportunity to do that. So it's been interesting to see that. But yeah, it's tough to get people excited. But one of the things that we've been saying is like 1% up over a quarter is way better than 30% down over a quarter. So it's a nice number to be able to throw out there.
It's price sensitivity. Like I think that's where you're going, Carson. Like the retail like participant is super price sensitive, and then the institutional participant is like, well, I'm concerned about risk and technology risk, counterparty risk. There's a whole suite of other things that they want to like package into how they think about their allocations.
When you look at the landscape right now of other yield-bearing stable coins or any other strategies, right? What do you think is working?
Credit and lending.
Yeah, I was about to say, we were talking about this just earlier today. So
it really is working. Maple obviously kind of paved the way there, and there's other like large projects and businesses that are moving into the space. Like the challenge is like the redemption window. This is a real problem in composability in this DeFi space. All these products were all built in the past to like serve a purpose, have kind of high single digit yields, maybe 10%. But then you try to translate them to a 24/7 market, and then you want to provide borrow lending capacities and leverage, and then the ability to trade these yields, and you're stacking product on top of product. That's what you want to happen, right? These are great things to happen for any type of product that you're building. But what it means is that you need to solve this problem in the middle, which is what if all of a sudden people want to get out of this product, or all of a sudden you have like a huge amount of demand for this product. And so you have these markets, which are like these, secondary markets that you need to maintain. And that's not done for free, right? That costs money, and the depth of liquidity is kind of pretty highly correlated with like the size of your product already. If you need more liquidity, you need more money, and there's cost of capital for market makers. And it gets quite complicated to kind of bring those types of things, which have traditionally like 30-day, 90-day redemption windows, into a market where you could have half of your protocol disappear overnight. It's solvable. We're starting to think of like interesting ways that we can resolve for that, and it kind of comes to this this idea of the repo, which we'll probably get onto. But those types of mechanisms that are available in the traditional markets to resolve these obligations, because that's really what it is, right? Like when we have a large amount of redemptions come to us, all it is an obligation for us to give them something. And so if we don't have the asset that we need to give them right now, then we need to get it from somewhere, which is us unwinding our trades, or selling something that we have, reaching into balance sheet, or it's finding that asset from a counterparty who'll give it to us at a lending rate which is offset or lower than other places where we get the capital from. And so I think some of those mechanisms that exist in TradFi will slowly make their way into this kind of stablecoin, yield-bearing stablecoin market, and provide that efficiency, which is going to enhance it overall.
Yeah, I think you're seeing a lot of like what we're doing is taking basically a strategy, and we're tokenizing it where we get capital in, and then we can go deploy it in our strategy, right, in a very institutional way. And we're seeing more of those types of plays come in versus like, I think traditionally when you think of like yield and vaults, right, it's like a vault will go out and like LP for you and go do very DeFi native versions of these things, where it's a lot more programmatic, it's a lot more like fully visible on chain, instead of this more like fund level being tokenized. And so I think it's very cool to see some of these things. I think, bringing more of these traditional funds and then giving permissionless access, right? I think that's one of the big things that we focus on, right? Is like traditionally, in order to get into the type of trade that we're doing, you have to be an accredited investor, be part of a fund, like have a large bucket of starting capital. But now you can get into it with, we have a bunch of people who are like, I made my first like $10 in yield off of $100, right? And like, that's cool to see. And like, that's not something that you normally get in just a bank account or the traditional tools that you have access to. So seeing some of these things, I've seen like basically like discounted OTC deals on tokens. I've seen lending, doing like professional lending of all sorts of assets. You're seeing a bunch of people do like really cool and novel, fun strategies that are now getting tokenized. So it's exciting to see a lot of that, that people are trying to bring these things in. But to Dave's point, right? It's like you bring this real world thing and you put it on chain, but that real world thing still has to live in the real world. Like it has to answer to regulations in certain jurisdictions, and it can't access certain things that you as an individual on the permissionless side get to access. So it's just a very interesting dichotomy, seeing how people are trying to solve for that as well.
Yeah. People want assets from the real world, but they're not ready for the real world to come.
Right. Yeah.
They're not ready to understand that fully yet. And it's actually hard to communicate those things in a digestible way to your intended audience, especially the more complex.
I think about it like this. It's like everyone wants like a Robinhood like experience, right? They want to be able to just bring their dollar in and put it on something and then go trade. And like Robinhood has done a fantastic job on making that experience super simple. But like Robinhood is dealing with like $1 in a bank account. And for us to do that in DeFi is like 10 steps harder, with like 10 levels of organization across 10 different counterparties with like 10 different things, where like Robinhood just has their bank account with dollars in it, right? And so like that level of sophistication is really hard to translate, when at the end of the day, for any user, both institution or retail, right, they just want to have their dollars earning more dollars to be able to go trade with those dollars. But like the complexity to make it happen permissionlessly is just so much crazier. And not even I knew how crazy it was before we really started getting into what it looks like to bring this out. Looking at the mind map that Dave has is just like gnarly.
It's bringing that user experience that a user expects, as Ryan's saying, from like Robinhood, and taking that into a bazaar. Like I think about it like, imagine if Apple provided that incredible service for all the guys that are in the bazaars all around the world and in the marketplaces, like buying and selling and swapping old iPhones, like making that also an Apple experience and ensuring that people are like, yeah, you get the great service and you're not getting ripped off and this is the right price. And, that's what we do in DeFi. You create these products and then you service the secondary market to ensure that it's as good a quality user experience as if you just came straight to the shop. It's quite complicated.
And I want to double click, David, on something you said about, these yield-bearing strategies around credit and tokenized real-world assets, tokenized private credit. A lot of these things are very hot right now. And the reason that is because the headline yields are quite large, right? You have the basis trade compressing. So you have some of these other stable coins going around 4 to 5%. And then you have, tokenized private credit, 12% headline APY, 13, 14. And then you see some other protocol doing a looping strategy and you see 18% APY and you're like, wow, that's great. But I think, as I was saying, there's so many complexities around that are not visible in the headline number, like exit frictions, redemption windows, complete opacity in what the underlying instrument is, and a hard ability and a difficulty in understanding what that is. So when we think about these tokenized RWAs, like, how do we get people to adopt them more?
It's the audience type. So that's what we've seen. So one answer, and there's going to be many answers to this, but we've spoken to a lot of super large hedge funds and super large funds that have been around for a long time doing retail deals or real estate deals or whatever they might be. And they might have already even just tokenized an asset, but they haven't seen adoption of it. And so what they want to understand is, how do we take this and grow AUM on DeFi? Like, we can see huge allocations out there happening. So why can't it happen to us? Like, it should be happening for us as well there. And the main thing is, it's just not the audience for it. Like, the audience is looking for something that gives them this flexibility and composability. And so that gap in knowledge between what's happening in the DeFi space about true composability between protocols, borrow lending, looping, there's a certain user base that really understands how to do that and what that looks like. And when you bring an asset from the real world that has like a 10% rate and you try to bring it on chain and you have to provide all these other services, that eats into that headline yield. So it might sound great, like, X fund is doing 10% a year, but then by the time you tokenize it, bring it in, pay for market making, huge amounts of liquidity, do partnerships, integrations, build tech teams, it costs millions of dollars to get to that point. So that's what we learned. We spent the last 12 months building that for one particular fund service, which is kind of what we do. Now we're in the position to scale it, so there's efficiencies there, but we're just early. Like, I think the short answer is, it's just not ready yet, but we're kind of getting there, and we'll start to see that adoption happen because everything will be composable. The problem you'll see is then there'll just be this like paralysis of choice. Like, should I be choosing X fund versus Y fund? And what will tend to happen is, something that's really common in crypto, which is like this term Lindy, and everyone will go towards the brands that they know and trust, and that will be the ones that they kind of touch and play with the most. Anything new coming in will find it very difficult to compete.
Yeah, I think one thing too about it is the user base that we have that really understands all this stuff is like quite small. And so like, if you look at total DeFi, I think, I forget if it was, I think it's like only like 120 billion. And so like when you look at like total DeFi and all of blockchain being 120 billion, and like any large TradFi institution looking at it, it's like, oh, I don't know if there's like enough money to even be made there, right? Smaller funds and stuff, I think, are starting to be interested because then they can outperform if they're stepping into. But then a lot of these traditional funds will come in and they don't truly understand all of the counterparty risks that can come into play, right? Like having like just coming in and using USX and EUSX, right? We have the counterparty risk, but then like, we're doing our trades and we do it through Binance and we have our custodial providers, right? Like all of that complication just from one token. But then if we introduce, like if they wanted to take that out, and one of the things that's very interesting that, we're seeing a lot of success with is talking about kind of our fixed rate PT yields that we're getting with Exponent, and talking to that, like, oh, you can take this and actually get a fixed yield for like, 4 to 6 months. Like that's really, really interesting. And the yield is, insert percentage here. That's cool. Like, how can we get in on that? But then they don't understand, like, now there's additional smart contract risk. There's another partner that you're having. Then if they're going to be taking that and trying to go do anything on like a looping thing, right? It's like, we have been vetting this for a very long time and we feel very, very confident about it, right? But like, not every project is thinking about all of the dominoes that come into play. And so if you see integrations that are happening that haven't been truly vetted, or if you see partnerships that aren't using proper custodians or alert mechanisms or whatever, right? There's like this domino effect that can so quickly, and today's point, right? Overnight, like one bad tweet goes out and like sentiment on your entire brand shifts. If the wrong person, like if a Zach XPT tweet comes out about you, like good luck, you know what I mean? And so, like it's just like, it's crazy how fast that sentiment can change. And then it starts, proverbial bank run on your protocol. And because it's fully composable and because instant access is a lot of the things that DeFi users expect, right? A lot of these traditional funds are coming in and they don't understand all those implications. We're trying to talk through a lot of that with them to show like what we've been thinking about, the due diligence on a lot of the stuff that we've done with our partners, and then how we deal in times of stress. Like luckily or unluckily, I guess, we launched like right when 10.10 happened and we didn't have any sort of problems. And so like we were immediately stress test out of the gate. 10 days in, stress test to the worst liquidation event ever for like what we're doing, right? And so now they see that we can survive these things. And so, but a lot of these other companies that are starting up that are throwing out these 13, 15% yields, and then they're trying to integrate into DeFi, but they're not doing all the right audits, they're not doing all the right checks and counterparty risk assessments. I think a lot of funds will stumble coming in and learning that very quickly, and some people might get burned.
Yeah, and the elephant in the room is incentives. That's a whole different game, right? There are all sorts of incentives that exist in this ecosystem, and what we have at the moment is an incentive structure in DeFi which just rewards size. So, it's like a watering hole. The biggest elephant comes up, it takes most of the water, and then they all just move on. And that's not really what you're trying to achieve, right? Incentives should be trying to achieve other outcomes, which are more about distribution. You want broad distribution for resilience. You don't just want the same 3 elephants to keep coming back to your fund and taking all the incentives and then leaving. Like that's not exactly the outcome you're chasing. So yeah, I think that's the biggest, hardest thing to compete with. And a lot of these institutional funds trying to come on chain with their RWA, they don't have some native token in the works because it has nothing to do with their entire company or anything they're trying to achieve. So they're competing in that space. But there are other ways to incentivize it. We've seen success from straight up stablecoins with just cash incentives.
When you think about incentives, obviously there's primary market incentives and there's secondary market incentives. And then when you think about secondary market, there's, I guess, types of holders. And I would never, ever classify holders as good versus bad, but there are different types of holders, right? So when you think about Solstice and both retail and institutional, and maybe that translates to use case as well, how do you think about the types of holders, what they do with it, what venues they're on? Like, are there specific things you're looking for, and what's the ideal end goal there?
Yeah, there's like, again, I wouldn't say good or bad users either, but I think like it's good to know what people like, what users are going to want to get out of it. And if you don't understand that as a builder or someone who's offering these incentives, like you will like, we both Dave and I have like a gaming background, and just like everyone's always like blaming the users on all this kind of stuff. But what you're trying to deliver to someone is like, hey, I spend time playing this game, I will get this reward out of it, and like that's what everyone expects, right? And so if you don't build for that expectation, which is like for us, right, mercenary capital is going to come in, they're chasing as much reward as possible, and there are protocols upon dead protocols out there that are like, oh, mercenary capital, and people only care about making a quick buck. Like that's a story that will always prevail in crypto. But if you don't build understanding that that's one of the customer types that you're building for, then you're never going to succeed. And so what we're looking for is like whenever we're building incentives, what drives the right outcome for us. And TVL is one of the main things, and that's primarily because it gives us more capital to put into the strategy and earn more revenue for our users and earn more revenue for us. And so all of the incentives are around like, hey, like mercenary capital, we are happy for you to come in and go get YTs or PTs or working with Kamino and doing lending, and we'll even incentivize you with more future token rewards on this stuff. But like the only way that you can get token is by actually committing capital. Like you're not going to get capital, or you're not going to get token, or you're not going to get incentives for like going to like, much to my chagrin, it's like not liking this X post that we posted out with like this beautiful redhead face of like a guy talking really eloquently about crypto on the timeline, right? And while it's good in theory, it's never going to reward the right behavior that we're going to want, which helps us to the bottom line. So building those incentives and understanding, like also understanding that the incentives are going to end at some point, and how to prepare for that as a business and an ecosystem, I think is really important. And prepping also those people who are coming in with mercenary capital or capital trying to chase the best yield, educating them up front. I see a lot of people all of a sudden they turn off the faucet and then suddenly change all the rules, and then like no one is happy. But if you're upfront, people are like, okay, I'm willing to give this 3, 6, 12 months. Like given the rules, given the framework, like it's not maybe not the best out there, but it's like good for my risk profile. And then everyone's like happy about it. It's like my wife always says, like communication is everything. Make sure we talk about it and make sure to share it out there.
Yeah. I think that's basically right. Like the only thing I would add is just you want people to use the assets. You don't really want them to just like get it and hold it. Like that's like the real Bitcoin mentality of like hold all this forever and it'll go up over time, and that's fine. But that's not really what we build. Like we build assets that should be used. So we want people to take those assets and either take them into the composable markets where we've put a lot of time and effort into building like relationships and technical integrations, and make use of them in DEX pools and borrow lend markets and trade the yield and whatever it might be, or as we kind of expand out, integrate our assets into payments platforms, use it to buy coffee, and those are the types of things we want to see. Like they're the like good holders, and then on the other side of it is someone who's just like holding it and parking it there, and it's not a bad holder, it just is a holder. Like that's just what they're doing.
David, you brought up an interesting specific use case that I'll transition into now, which is more of the borrow, lend, repo markets, both on DeFi and in terms of CeFi lending. I guess when you think about that specific use case, lending, repo, how is USX working? Not necessarily to incentivize, but just to involve its asset in the borrow, lend, repo markets.
Yeah, this is like, it's something I'm pretty excited about. Like I think about this a lot. Like some of the really big challenges you have when you're creating a token issuance entity, like what we are, stablecoin issuer, yield-bearing asset issuer, is you need to provide liquidity for users to get in and out of this asset. And so what you really have, and I kind of touched on this before, is like an obligation is what you're saying. It's like if we've issued all of these stable coins, like someone's given us something in return, and we have this obligation to be able to give it back to them in like a really short time frame. You don't want to be like, I'm going to give it back to you in a few years from now. You'll never have a efficient protocol, and it's a very inefficient use of capital. So with this kind of idea of like using like a repurchase agreement, it's something that's like really common in traditional markets for like overnight lending, which has exploded. There's been some problems, like 2019 had its challenges, and like it was solved by the Fed stepping in. But really what it is like it's just some entity has some obligations coming due, and then instead of like having to go to sell all their assets to pay this bill and then like get it all back, like they're just able to like do a very quick, efficient swap, meet their obligations, knowing that tomorrow they're going to have more than enough capital to cover that cost, and then do the swap back and get the underlying treasury bonds in TradFi, or in our case, particular stablecoin. And so we have like two really clear use cases that like have emerged in the way in which we like deliver our asset to like the broader DeFi ecosystem. Is we have decentralized exchanges which are full of liquidity, and so they have a pair. So USX and EUSX have a trading pair, USDC at the moment. We're looking to migrate that to another stablecoin pair, which is super exciting, create some more flexibility and capital efficiency. But when we get into a situation like we did on Christmas Eve, Christmas night actually, where we had quite a lot of selling, which was unexpected. Traders are offline. You basically have less people around to manage for this. Mm-hmm. And so the market needs to step in for itself. And so we had this volatility event where USX was sort of depegging. It just like moved away from the price it's supposed to be at. And all that meant was there was just nobody there just to buy up on the other side. So what's really interesting about peg management is in that decentralized exchange, what we needed to do was step in and provide our market makers with USDC to make available. And so we could do that in a couple of ways. We can like sell some assets that we have, take it from our balance sheet, or what would be possible in the future with more efficient kind of repo markets is we have a lot of USX and EUSX available in-house. And we don't like to see our assets under management number whip around too much, right? Because that's something that also builds trust in the market. And there's other reasons you don't want to do that. It just like pulls money out of the trade as well. So what we can do is like post USX or post EUSX to a prime broker or a partner who enable us to be able to do this repurchase agreement using our own asset. And so directly onto the exchange, it's quite exciting because you can just like do this swap and then like put the capital into the exchange and then know that you can kind of redeem it from yourself, go back and do the swap back. And that's really useful. But now, since we had this liquidity event at Christmas, we've included now an instant redeem liquidity buffer, which is really just like a bucket of USDC, which causes a massive cash drag to our protocol. And so instead of having that bucket be really large, we can have it small and efficient. And then in moments of, overnight obligation problems, and we can very quickly do a repo exchange and then fill that bucket up to what it needs to be, and then swap it back the next day or 7 days later or whatever it might be. So there's two really distinct, what I call defensive use cases. So like peg management on the exchange, and then ensuring that our liquidity buffer is like sufficiently, bolstered to kind of meet the needs of the market, whatever they are, as the environment changes, have been like really, really, really interesting ways in which we can use the repo. The thing that we haven't been able to deploy yet, which is probably even more exciting, is what I kind of think of as offensive, and our legal guys don't like us talking about it this way, but like it's really when we get into
because you only get the marketing guy, so that's easy to get by on this one.
We can get in a position like that 20% of the year when we make all of our returns, when the funding rate turns around, where all of a sudden funding rate spikes to 15% or 17%. And we can do this repo with like underutilized USX and then get more capital to amplify the returns, essentially provide leverage without creating leverage because we're just swapping an asset and having a repo. So we haven't had a chance to proof of concept that yet, but those first two defensive cases have really been able for us to like test it out. It's like it's something that we're going to deploy as like a strategy going forward, like having that in place for us to quickly be able to do it. And what I hope to see is that repo rate now for us is quite high, right? We have a big haircut and it's quite expensive, but over time, USX will become more and more trusted. USX will become more and more trusted. That kind of repo rate in this stablecoin space will get compressed. And then other stablecoins will hopefully start to do that. And then there'll be this benchmarking between those collateral assets. Like, okay, USX is this 5% and this is 10%. And okay, fine, you can kind of swap them around and you figure out where you're at. Creates a lot of capital efficiency in it. I think it's a pretty interesting opportunity for all like stablecoin issuers.
So I mean, as you rightly said, as stablecoins issuers get more involved directly with these curves, I think we think every stablecoin will eventually have a specific term curve, right? That is defined by repo with various prime brokers, and really every stablecoin should. And there's various benchmark rates out there across the space, like there's CDOR from CoinDesk, there's various indices out there, but none of it's all of it's based off a specific algorithm of variable rate markets that are all based on pools, right? There's nothing out there really that is true repo markets between bilaterally defined fixed rate counterparty visibility. And that's exactly what, you guys have involved yourself in, which is fantastic, and what we're trying to grow here. So it's really great that USX is getting involved in this.
I also think it's really cool because, we're talking about a lot of the times, right? We're talking about how do we get more TradFi funds interested in here? Where can they come and access? And this is one market that they are very familiar with, right? Mm-hmm. And it's a really good way for us to, as an industry, right? Introduce ourselves, introduce our brands, introduce our this concept to them, and then they get used to working with crypto organizations. They see how we work, they see how we operate, they see who they can trust, they see the assets that we're using in all these different things, and get very familiar with us, which that familiarity will only help ingratiate ourselves even more with these people. So I think it's really exciting because we brought this up, and Marcus, one of the leads over here, he talked about the repo on stage and had 4 traditional large funds come up and were like, now repos we get, what are we doing here? How can we talk? Let's set up a call for next week, right? And so that's really cool to see when you can strike something that has that level of uptake and interest very, very quickly.
Yeah,
it's a great.
There's a huge landscape here of opportunity. The size of the repo market is enormous, and like Ryan was saying, traditional investors understand it. This is a multi-trillion-dollar industry, and if I just try to illustrate a case, if you think about a shipping company, they'll be holding treasury bonds on their balance sheet and earning next to nothing on it, and then they have these obligations to me. They're swapping and changing. It takes time, and the repo market's pretty efficient, but with it, if they were just holding, EUSX, earning on average, 9% a year just on the balance sheet as a treasury management solution, if they all of a sudden have this obligation where they're oh, wow, this thing has kind of run us afoul, whatever the Suez Canal issue crops up, they just know they just need a repo solution. They can just do that repo thing with their stablecoins instantly, right? It can be instant reaction. And then they're okay, now we have this other asset we need, which we can then use to make this payment because EUSX is not a useful payment solution, right? It's used as a growth solution. I think we're going to see a lot of that. That's when, the real world comes on chain, these real traditional businesses coming on chain using crypto assets in their treasury management. That's when you'll get that tap into the repo thing. For now, it's going to be this early testing phase where token issuers are doing things like we're doing, and trying to fend off these hostile arbitrages, for example. So it's a little bit different for now, but hopefully
they're not hostile. They're different customer segments that we're learning how to deal with in an appropriate fashion. Okay.
But you are the marketing guy, aren't you?
Yeah.
These arbitrages are quite interesting as well, right? You think of them as, okay, they're great. They arb the peg. They bring it back into the price it should be, but it's a closed system. All they're doing is taking money from someone. It's either from the protocol or it's from the user who has got a bad trade, really. They pay too much or pay too little or whatever it might be. So those arbitrages don't need to be there if you have a really efficient capital market. And obviously repo provides that in the traditional finance.
Yeah, I think we think at Membrane that the repo markets for crypto native assets are inevitable. And I think what we try to provide is the operational plumbing to provide that. I think the space is still very immature in that sense, both operationally, legally. Very few people in the space, institutions, transact with a JIMRA. They all have their own custom documents. Getting people on a standard, getting people transacting quickly, getting people familiar with these structures, I think is one of our main goals. And I think we'll unlock a ton of capital market efficiency in this space. So it's one of our main goals. I'm glad you guys agree, right? And like you said, David, that there's tons of people in the space who are interested in repo, familiar with it, and to other participants' credit, they're working on tokenized U.S. Treasuries for U.S. dollar, something like that. And that's very interesting, and we have that available on our market. What we're more interested in is the digital asset native repo. How do we bring these to assets that your counterparties hold? Crypto native institutions, they hold these assets. They want the same repo flexibility and ability, but with digital native assets, as opposed to having to just do it with a treasury. So getting every repo native yield-bearing stablecoin or RWA enabled as repo eligible collateral is I think would be a massive unlock.
All right, so David and Ryan, we've covered a ton today. I think maybe to wrap up, I'd love to hear a little bit about what the future holds for Solstice Labs and what's next for you.
Sure. It's a big question. We're in the midst of this as well, right? Like it is super common in the crypto industry when you see like a lot of volatility in the market, you kind of question whether or not you're headed the right direction. So, we're kind of thinking the same thing. What we've done so far has been incredible. Like we've built this huge platform, took us 6 months of like super hard work to get it live and 6 months of testing for stabilization. And now we're kind of there. So it's, what do we do now? Like hyperscaling AUM is like super interesting, of course. Like the more money you have under management, the more trusted you are, the more money you make, and it gives you more flexibility to build other things. But I think the crux of where we want to go is scaling what we do really well to where users are. How we execute that is like really the big problem. And that's kind of where we're headed next. I think 2026 will be about us, really defining what users are doing in their current behaviors. Like I personally don't think, and I think we have this view in the business, like we don't want to be like a super app destination. We want to be something that augments and services people wherever they already are. There's so many people competing for attention. There's already so many fintech apps. All these guys have done incredible jobs. For us to go in and try to displace someone's pre-existing user behavior is probably like a fool's errand. So I think 2026 looks something like, defining and proving that we can bring yield to users no matter where they are and no matter who they are. And then once we prove that out, it's hyperscaling that. And so, I think we're still super committed to doing this with Solana as like the underlying. I think Solana's come to a point now where it's proven itself to be institutional grade. The speed to finality of Solana is what we think gives us the edge and why we do it in Solana and why we're committed to really staying there. And then taking that speed and then bringing it into fintech is something that we think makes a lot of sense. So that's my view. I think it's like bringing what we do really great to everybody where they are, rather than demanding they come to us.
Yeah, and similarly, right? It's like we talked about before with incentives. How do we get users who are in crypto to integrate us into their DeFi stack? But it's how do we get users to use yield or Solstice-based yield in their everyday life, right? So it's really like, to the example that I said before, it's a small business that is setting up some website somewhere and they're using a payment provider, and we just happen to be partnered with the payment provider to help do yield on the back end. It could just be like a card app that's looking to help you spend dollars wherever in the world, and you don't have to have some sort of bank account. You can have some sort of permissionless neobank on the back end, but the neobank doesn't necessarily have the yield infrastructure powered by Solstice. So I think that's what we're thinking about is distribution by having the best yield product out there that's the most interoperable across the ecosystem.
Ryan, David, thank you so much for joining us today. We covered a ton of stuff. I'm very excited for what the future holds for Solstice. I know you've already hit the 300 million TVL mark, and I think there's a ton of growth to come. So thanks so much, and we'll be talking soon.
Thanks for having us. This was great.
Yeah, thanks for having us.
Thanks for watching. Brainstorm is brought to you by Membrane Labs, the operational layer behind digital asset credit, collateral, and settlement across the custodial ecosystem. Learn more at membranelabs.com and subscribe below for ongoing insights into how digital asset credit is evolving.